Hello, everyone. My name is Majesty. I am an Atlanta-based real estate developer with $13 million in assets under management and another $50 million in the pipeline. I build and rehab apartment buildings, so stick around for some investment tips. I'm doing a 100 question series, one question a day. And today's question is, what is the BRRRR strategy in real estate? And BRRRR is BRRRR. So BRRRR and then four R's. BRRRR is an acronym. It is not Gucci Mane's ad lib. It is an acronym in real estate that stands for buy, rehab, rent, refi, and then repeat. And refi, I mean refinance, just to be clear. So buy, rehab, rent, refinance, and repeat. It is an investment strategy that a lot of real estate investors use to grow their portfolio. So I'll break it down step by step. So the first step is buy. That's pretty straightforward. You find something that fits within your criteria, a good deal, and you buy it. You acquire it. You give money for it. Most likely not your money, but the lender's money. So you acquire a piece of property, and then you rehab it. So you need the property to need a little bit of work. Because that's how you create the value. So that's the rehab, which is the construction part of it to improve the property and make it better, make it more valuable. And then you're going to rent it out. You're going to rent it to somebody. This can be commercial or residential. So you can rent it to a business if it's commercial, or you can rent it to a person if it's residential. But you want to get somebody inside of it. You want to get it generating income. You want to have it managed, all that stuff like that. And then you refinance at that new stage of having it rented. And the reason you do that is because it is valued differently at that point, which allows you to do the next step, which allows you to do the refinance. They're going to refinance, they're going to value it based off of you doing the rehab and then having a tenant in there paying, so you're going to get a higher valuation for it than you did when you bought it, because you've added value. So and then repeat, pretty straightforward. And the benefit or the biggest thing about the BRRRR strategy is that whatever amount of money you put into it, through the buy, rehab, and rent phase, you typically can pull all of that out on the refinance and now turn it into an investment that you no longer have any money in. You get to keep the asset, you get to keep the renter, so you still have the income, but you no longer have any of your cash in the deal. So that's the power of it, and that's where the repeat comes from as far as being able to scale your portfolio. Because, and we'll go through an example, but essentially you're able to kind of do this to infinity if you do it correctly. Even if you just bought one, two, three houses a year, and did this, you can only imagine how that can compound into a pretty significant portfolio over, let's just say, 10 to 15 years of doing it. And you could do something like that part time as well. So that's something that's probably the biggest benefit. I mean, obviously, you're getting cash flow as well because you have a renter in there. The idea is that your debt service, your mortgage payment, your loan payment is going to be lower than the rent that you're taking in. So you'll have cash flow, you'll have the property. The property will still have equity in it, even when you do refi. They don't let you pull 100% of the value out. So anywhere between 70 to 80% roughly, you can pull out. So you'll still have that 20 to 30% equity sitting in there that's yours, but you're able to do it again. Now, as with everything, there are risks. And these risks are pretty common across any real estate project, but the market can change while you're doing your BRRRR strategy. So I mean, you have to buy it, you have to rehab it. That takes time. So let's just say that takes 3 to 6 months. During that time, something could happen, obviously, in the markets that changes things. Also, your rehab can not go as planned and then extend your timeline, which also causes some issues there. Also, your financing, it could just not line up on the second part. But it's a two-part finance deal. You're financing when you buy it, but you're also financing when you refinance it as well. So that's two different closings, unless you're able to work it out where you can get some type of product that closes both, which is possible, but not very likely. So it's going to be two different loans. So it's possible that your second loan, the refinance loan, doesn't work out as planned because of some other issues. So those are probably your main risk in the BRRRR strategy. And then your money will stay in the deal longer than maybe you want it to. So I'll give you a quick, simple case, not actual numbers, but enough to make sense. But so you buy a property. Let's just say you buy a property for 100 grand, right? And then you put 50 into it, right? So you're all in for 150. With most hard money lenders, which give money on deals like that, they're going to require, let's just say, 10% down to make numbers easy. So you got $150,000 of project costs. Remember, you're buying it for 100, you're putting 50 into it. That's 150. So they're going to give you 135,000 of that. You're going to have to bring 15,000 of that out of pocket. So that's your cash, like in your bank account, wherever it is, Bitcoin, and you put it into this deal. While you're rehabbing, your money's still in this deal. You're using the hard money loan to do the most of the work, but your money's still in the deal. Then you rent it out. And let's just say you rent it out for $1,500 a month, which is the 1% rule there. So you're getting that money coming in. You do have a hard money loan payment. Let's just say it's $1,000, so you're getting $500 of cash flow. And once you have that renter in there and kind of stabilized, anywhere from 30 to 90 days usually. Sometimes they want longer, but usually 30 to 90 days. Then you go back to your lender and say, look, I've rehabbed the property. I put 50,000 into it. I got a tenant paying 1,500. Let's just say the property is now worth, I don't know, $250,000, right? So they will give you roughly $200,000 in a refi. Because you've done all this work, you have a renter in there. So the property is now worth $250, and they'll give you $200,000. So you're able to deduct that $150 from that, and that's how you get your $15,000 back right then and there. Sometimes, as in this example, you come out with even more money because there's a $50,000 gap between $200,000 and $150,000. And this is very, common in real estate. So this is a powerful way to grow your portfolio, because essentially you could take that 15,000 that you put in at the beginning and now just churn it into another project. So you find another project that does the same thing, and now you have an extra 50. Maybe you can do more than one. So you see the power of the BRRRR strategy and why people use it. The market does have to be in a certain position for this to work, because you have to be able to buy it at a good deal, and then you have to be able to refinance at a good deal in terms of interest rates and everything like that. And then you also need to be able to have a good renter market where you can get a renter in place. So some things have to line up, but it's one of the most tried and true ways to grow your portfolio without needing a lot of capital. Because remember, I only put in 15,000. I got my 15,000 back, and I'm going to throw it right back out there and do the same thing again while I get to keep this one, and just kind of, it's a monopoly game almost. So anyway, that's the BRRRR strategy, and I highly recommend it. I've used it successfully, and many people do. So it's something to consider. I appreciate you guys for checking out this video. Make sure you like, comment, subscribe, share your experiences and questions, and until the next time, I appreciate it. Bye.